Okay, well, welcome to our April edition of the Real Estate Rundown. What we do in this webinar is just go through the latest market stats, real estate news, mortgage programs, and things like that. So I have a pretty good agenda for us today, and I'm just going to breeze through it, but anybody feel free to either unmute yourself or throw comments in the chat, and we can make this as interactive as you want to be. So all right, so here we go. My name is Daniel Jackson. I'm a loan officer at Nova Home Loans. I like to be more of a financial educator and make sure that clients know exactly what they're getting themselves into when they're making their mortgage and housing decisions. This is year 21 in the mortgage business. My daughter's just turned 21, so that's how I keep track of that. Also on the call, we have Paula Boyson and Joe Figueroa, loan officers on my team. They've both been with me for a long time. And then Jennifer Humphrey, not here today, but she's our credit analyst on our team. And her full-time job is just working on credit and helping people to qualify for the best possible interest rates and programs. So the agenda for today, we'll go over some recent news and market stats. And then we're going to be reviewing down payment assistance options that are currently available. And then some winning strategies of buying investment properties with DSCR loans. Kind of a cool way of financing investment properties. And then the latest strategy that has come out is a new program for financing solar panels. So I'll go into that briefly as well. And that is it. So in the news lately, we're seeing a lot of articles like this where it's talking about, they call it the lock-in effect, which is the fact that so many people have lower interest rates than the current market that it's making them hesitate to make a move. So especially if you bought a house during the pandemic, you probably paid a lot less for it than it's worth today. And you probably have a much lower interest rate than you can get today. And so refinancing or even selling your house to downsize or upsize is out of the question for a lot of people because of that lock-in effect. They feel like they're locked into their current house. But that being said, a lot of people are still have a lot of reasons for staying in their home longer than they have in the past. We used to always say that it was the average homeowner stayed in their house about 7 years, and now the stat is closer to 9 and probably rising. But the biggest reason people state for keeping their current house instead of moving is I have a lower mortgage rate than current rates. Obviously, there's a lot of other reasons here listed, but that's the biggest one. Yesterday was not a great day for mortgage rates. This was a CNBC yesterday. Real estate's the worst sector today. Mortgage rates went up quite a bit. We had the worst day since October of 2022, I think they said. Oh, it's right here. Basically the worst day for mortgage rates since October 2022. I don't know if you can see this over on the right, that this is the 10-year treasury. And yesterday it went up a good 0.3% or so. So that means higher mortgage rates. The 30-year fixed rate mortgage average is 6.82, and it's been staying pretty steady this year. But I bet next week when they come out with it, it's going to have bumped up back up over 7%. So the news that is pushing the higher rates is pretty much inflation. So this is a little breakdown of the inflation report that came out yesterday that kind of drove the big market move called the Consumer Price Index. And they break down inflation. They said inflation is about 4%, 3.8% year over year. So everything is more expensive. Now, when you dig into it a little bit, they have it broken down by different sectors. And the biggest thing that's gone up a lot is shelter expense. Now, that doesn't mean mortgage payments. It's talking about rent or owner equivalent rents or lodging away. But that was the biggest thing that has gone up, and it's really pushing the inflation numbers higher. The second one I thought was interesting, motor vehicle insurance, up 22% year over year. Other things, gas, food, I mean, everything's just more expensive right now. So half of American households are struggling to cover their rising housing costs. Majority of homeowners and renters say housing affordability affects their pick for president. So I don't like to talk too much about politics, but that's something that's going to come into play as we get closer to the presidential election. Is it's bound to make a difference in the decisions that the government is making to that affect housing. We've already seen President Biden come out with a plan for some down payment assistance and housing affordability, but the pressure on the Federal Reserve to start cutting rates and making people feel better about their spending is going to be high, I think. So I think we're still likely to see rates come down a little bit as we get closer to the end of the year. Now, that being said, the Fed has come out and said, when are we going to cut rates? Well, maybe later, maybe not at all. We were expecting at the beginning of the year to see rate cuts as early as June of this year, but now the chances of that are pretty slim. But I think starting in September, we'll probably start seeing rate cuts. That's just my opinion. Okay, switching gears a little bit. This is a little stat that I thought was fascinating. $1 today has the same buying power as 4 cents in 1872. So that is the effects of inflation for you. You can buy as much with the dollar as you could with 4 cents if we were in 1872, for whatever that's worth. Okay, let's look at the Yuma housing market. The average home price, this goes month by month back to 2005. And you can see there's ups and downs. We had a peak and then a dip. But for the most part, we're pretty flat here over the last little while. If you go back in percentage change year over year, I like to look at this because it shows you monthly which months we actually saw decreases in sales price. And there's only a few. It felt like the home prices have been dropping, but they really haven't. We've seen a few months where home prices have been lower year over year. But this last few months, March was 13.8% higher than March of last year. But remember, March of last year was kind of in the toilet, so take it for what it is. That 13% jump doesn't mean that home prices are super high. It's just they're back to where they were maybe a year and a half to 2 years ago before that dip. Now, the other side of it is units sold. So how many homes are actually selling? And last year we averaged about 180 sales a month. And this year you could see these ones over on the right, 186 in January and 213 and 251. So there's been quite a few home sales. The number of homes selling this year has been picking up. Now I'm taking this exact chart and then I'm overlaying it on this next one. So the blue was those sales, and then the orange is new listings coming on the market each month. So if you look at this, the last 3 months for sure, and actually the last 7 or 8 months, you can see that the orange bars are taller than the blue ones. So we're actually adding inventory to the market. We're adding homes, more homes than are actually selling. So that's a good thing. This is a breakdown. I just got this yesterday from Quincy at ERA. And this is a breakdown per price range. So if you look at the number of houses that are currently for sale, it's really small in the lower house ranges until you get up to the 350 and above range. And then when you take that and compare listings versus sales, the black is the current listings. So you can see there's more sales than listings in every single price category up until the 350,000 range. So if you're trying to buy a house under 350, it really is a pretty strong seller's market. And then the 350 and above, there's a little more of an imbalance where there's more homes on the market than are actually needed for the current demand in those price ranges. So all that being said, that points to home prices continuing to go up. This is for Yuma County. It shows we have 63 years of data on what home prices have done, and the overall average is 4.1% appreciation over the last 63 years in Yuma. And forecasted for this year, 3.89, so it's a little bit lower than the average, but it's still forecasted to be going up. So what that means is if you bought a house today for 286, 5 years from now, it's going to be worth 342,000. So if you're waiting to buy a house, you're probably going to end up paying more for it in the future than you would today. So, okay, moving on. Let's talk about down payment assistance programs. So when the customary down payment for an FHA loan is 3.5%, and if you're a first-time homebuyer, you can qualify for a conventional loan with only 3% down. So when we're talking about down payment assistance, we're talking about getting into the house with less money than that. So if you're good with putting 3.5 or 3% down, you don't need down payment assistance. But if you want to get in with less than that, then you'll need some kind of assistance. So there's a few different programs we're going to go through, and then I'll talk about a couple of other strategies. But when you look at the down payment assistance options, they vary drastically by state and county. So where you're buying your house really matters. I'm going to go over mainly the ones for Arizona and for Yuma County, but there's different programs in other states. Some of these programs actually work in all states. And then Maricopa County tends to be segmented off from the other counties. And so there's different programs in Maricopa County as well. Some of the programs have income limits, and when they do, this is the link to look up the AMI, which is the adjusted median income. Then you can look up those, and I'll just show you screenshots of them for Yuma. Now, there's different options that are either repayable, meaning you have to pay the down payment assistance back, or forgivable, meaning you don't. It's forgiven usually after a 3 or 5 year time period. Some of the programs are just a true gift where you don't have to pay it back at all. Some require you to be a first-time home buyer, and some don't care if you are or not. There's temporary buy-down options, like you can do a 2-1 buy-down and combine that with your down payment assistance to get a lower interest rate and a lower monthly payment for the first year or 2 of your loan on some of the programs. Now, some of them have stricter credit score and debt to income ratio requirements, which just means that sometimes if you put your own down payment down, then you'll qualify for a lot more home than you will on the down payment assistance program. Like we've had people where we could tell them, hey, you qualify for a house up to 400,000, or if you use the down payment assistance, you can get up to about 325. So you see a pretty big difference in how much you'll qualify for on some of these programs because they're more restrictive on the debt to income ratios in some cases. Also, depending on the type of property that you're buying, if you want a manufactured home or a condo, some of the programs will allow for those properties and some want single family homes only. So now this is not a program, but mortgage credit certificates is a strategy that we can use sometimes with first-time home buyers to help you qualify for a little bit more. The tax credit is a $2,000 for every single year that you own the home. So, and we're able to use that as lenders as income, qualifying income to help you qualify for, it's about 25 or 26,000 more home that you'll qualify for with the MCC. And then you as a home buyer, every year you own the home, your income tax refund is going to be $2,000 more. So it's kind of a cool program. You have to be either a first-time home buyer or a qualified military veteran to qualify for that. The income limits are not super restrictive. You can make 82,800 for 1 to 2 person family, 3+ persons. So if you have a kid, then you can make up to 95,000 and still qualify for it. All right. There's also a $2,500 credit from Fannie Mae or Freddie Mac, and this is a one-time, basically free money to help you with your home purchase, but it's for low income. Their income restriction on this one is 50% of the area median income, which in Yuma County, you can see down here in the corner, that comes to 35,000. So you can't make more than 35,000 a year and get the credit. But if you're in that income bracket and we're able to qualify you for a certain amount of house, then you'll get an extra $2,500 credit to help you with your closing costs and lower your funds needed to buy the house. And that's free money. Okay, a new program that just came out. So here's the first down payment assistance program we'll talk about is the Arizona is Home 4% DPA. So the AZ is Home program is available in these counties down here, which includes Yuma, pretty much everywhere except for Maricopa County, I think. You get 4% of your sales price, and it's a 5-year forgivable. So that just means that if you keep the loan and the house for 5 years, then you won't have to pay the money back. If you try to refinance the house in less than 5 years, or if you sell the house in less than 5 years, then you'll have to pay it back. But if you're a first-time home buyer or a qualified veteran, and you're within the income limits, which is 80% of the AMI, so that puts us on the second line, which is 56,000. So you can make up to 56,000 a year of household income, and you'll qualify for this program, 4% down payment assistance, and it's a 5-year forgivable. So that's a pretty cool program. We have another one that is truly a grant. This one, you don't sign any kind of agreement to pay it back under any circumstances. It's basically gift funds. They'll give it to you at closing. It's called the Empowered Home DPA. Pretty much everybody qualifies for it. You have to qualify under one of these categories over here on the right. If you're a first-time buyer, you automatically qualify. If you are a volunteer, then you qualify. The volunteer is kind of the catch-all because they said you could go down to the what do you call it, Goodwill or soup kitchen or whatever and volunteer, and then you can say, okay, I've volunteered before. Okay, you qualify. They have income limits where if you make more than the income limit, then you can go volunteer instead and still qualify for the program. And then also, if you're buying in an underserved census tract and you make too much money and you don't want to volunteer, then we could look up the house, and if it's in one of these underserved areas, then you'll still qualify. Basically, this one gives you 3.5% of the sales price, free money. It's a grant. You don't have to agree to pay it back. You can have up to a 50% debt ratio. The credit requirements are super low, and it is going to be a higher than market rate, 7.75 currently. That can change, but it's a higher than market interest rate. So that's the strings that are attached, is that. But if you were to combine this program with some seller concessions to cover closing costs, you could really get into the house with almost no money out of pocket on this program. Okay, another program is the Arrive Home DPA. This one, you can choose how much you get, 3.5% or 5%, which is nice because we can use some of the money for your down payment and some of it to cover part of the closing costs, or buy down the interest rate. The 5% option is only available in repayable form, which just means you can't get the forgivable option. Now, what happens is it lets you choose if you want 3.5 or 5, and it lets you choose if you want to pay the money back or not. If you choose to not pay the money back, you're going to end up with a much higher interest rate. So most of the clients that we've worked with that have done this program end up opting to take the repayable money, just because you get a more realistic interest rate. You're not way overpaying for it. It doesn't give you a super high monthly payment. Now, in the repayable option, that means you're going to have a second mortgage and a second mortgage payment to pay back the down payment assistance. So all that factors into the reason why you end up qualifying for a little bit less on these types of programs, is because you'll have a second mortgage payment and a little higher interest rate. But the good side is there's no income limits. It's available in all states. Manufactured homes are okay. 600 credit score is okay. And it's going to end up being an FHA loan. We have another program called the Nova Advantage DPA. This is an in-house program that we do. Very similar to the Arrive Home. We usually price out both and just see which one offers the lowest interest rates, and then go with that. So the Chenoa program is another one that's available in all states and offers both options, either repayable or soft second. What else? On this we haven't used this program much lately because the rates tend to be lower on those other two programs. So, but there's no monthly payment if you take the soft second, and it allows down to a 600 credit score. They also do manual underwrites, and so it makes it to where this is a program that's pretty easy for us to get people qualified on. So,
Aaron has a question on the other two. How long do you need to wait to refinance if you do those last two? Not Chenoa, but the two before that.
Yeah, so because most of the people are taking the repayable options where they're making a second mortgage payment, they're expecting to pay it back anyway. You can refinance anytime. So pretty much if you're in an FHA loan, you need, I think, 7 months, which is basically your first 6 payments. Once you've made your 6th payment, then you're eligible to refinance to another FHA loan. The thing to keep in mind with these is that you're borrowing 100% or sometimes 101.5% of your sales price. So your house has to go up in value, or a combination of you paying the loan down and the house going up in value before you're going to be eligible to refinance, because you're going to need at least the 3.5% equity to refinance. Does that make sense? So you'll be eligible right away. The only thing stopping you is going to be the equity. So.
And how about Arizona Home Grant? Do you have to wait?
Arizona Home, the AZ is Home, the 5-year one?
Yeah.
Yeah, that one you have to wait the 5 years. Okay, so here's a couple of recent examples of ones that we've done. So this first one was a new construction home in San Luis, $245,000, $350,000 sales price. There was no seller concessions on this, but they got $12,268 of assistance. So the buyer was able to get into the house with just over $5,000 total out of pocket. A monthly payment of $2,135. This one had seller concessions, so $288,000, a little higher sales price. The seller paid $59,52, $14,400 of assistance. The borrower got into the house with $688 total out of pocket, which was $1,000 of earnest money paid up front, and then a $322 $312 refund at closing. So he had to pay $688, but he felt like he was actually getting money back when he closed on his house. So that was pretty cool. Other questions about down payment assistance? Yeah, Karen, unmute.
Sorry. Do you have anything specifically for like service people and teachers? I have a teacher who's asking right now.
So yeah,
Really
some of the
good.
programs, the AZ is home. There's also Home Plus, which we took out because it hasn't been really viable lately. But there's certain programs that will give them extra, that you get 1% extra if you're a they have a few different categories: service member, veteran, teacher is probably on the list. We'll have to look. So there's another great program. We didn't put it in here because it's not down payment assistance, but a good program for teachers. We have a graduate program that is for anybody with a 4-year degree. This is great for medical professionals and teachers. But if you have a 4-year degree, then you can qualify for the graduate program, which is a 5% down, but no PMI. So it ends up being a much lower interest rate.
Okay, thank you. What was the other one called? You said, the one you said you took out?
Oh, the Home
First-
Plus. Home
Home
Plus.
Okay.
Yep, Home Plus is another option that sometimes
service
good for teachers and service people. Yeah.
Thank you.
All right. Okay, let's talk about DSCR loans. So DSCR stands for Debt Service Coverage Ratio, which basically is just a math problem that we do. And it's for buying investment properties. And this type of loan, instead of using personal income, tax returns, or your rental income from other properties you own or things like that, self-employed income a lot of times is super complicated. And then you combine it with owning multiple properties, and it just makes for a nightmare of trying to get a loan. And so a lot of people hesitate to even apply for loans because of their income situation. So a DSCR loan is a great way around that. And instead of using their personal income, we're qualifying just using the cash flow off the property that you're buying. So that ratio is calculated by just taking the rents that you're receiving, divide it by the monthly payment of the subject property. And as long as the rent is going to be more than the payment, you qualify for the loan with no income documents. So 20% down, 720 credit score. Oh, I guess I didn't finish putting that together. So that's pretty much it on this program. You're going to need to put at least 20% down. You need to have good credit, because basically what you're getting a loan on is you're getting a loan on the cash flow, the fact that the property cash flows, you're going to be making money on it, and then that's it. And then the strength of you as a borrower. So your credit score is important on those two. All right, so that's easy enough. One more thing to talk about is Solar Technologies Program. So FHA recently changed their guidelines to make it easier for people to finance solar energy systems with their home. So the full cost of a new solar array can be added to a regular FHA loan at the time of the home purchase to include all the costs, including installation and everything. So there's very few lenders that do this program, and there's very few solar companies that do this program, but I think it's going to grow quickly. But as of right now in April, nobody else is really doing this. Basically, you don't have to get the market value of the system. Like, this has been something that FHA had an old program, solar and wind something, I forget the name of it, but they had an old program that we never used, the green mortgage or something like that. But we never used it because it required you to get an appraisal that was high enough to cover the cost of the solar. And that never happens because there's just not enough data for the appraisers to say, okay, it's going to cost 50 grand to add the solar, and that's going to add 50,000 to the home price. It just doesn't, the math never works. But on this program now, you don't have to do that. The appraisal just has to be for the house. The cost of the solar system is irrelevant, other than it can't be more than 20% of the total purchase price. So complicated loan formula. Yeah, there's no complicated loan formula on this. It pretty much is really simple. Basically, they have to own it. It can't be a lease. And then it can't be more than 20% of the appraised value. So for example, 500,000 purchase price, you can't roll in more than 100,000 for the system. You can include the battery, all of it in any roof repairs that are needed, all of the installation costs, all of that stuff can be included in here. It has to be a new system. They have to qualify for the total loan, obviously. And then we have to run it through FHA's underwriting system. So it's fully available in Yuma. We can't combine this with any down payment assistance options. So they'll have to put 3.5% down of their total purchase price plus the solar. But other than that, that's all there is to it. So if you have somebody that wants to buy a house and add solar to it at the same time, then we can do it. Okay, one more thing I want to talk about is called the commitment to lend, which in this market, I think the stat, oh, it says right here, 1 of 3 homes. It's like 36% of homes is selling for all cash lately. And so sometimes, especially if you're in the lower price ranges of 350 or under in Yuma, it can be hard to compete with those cash offers if you're a finance buyer. So something that we're doing is our commitment to lend program, where we take people through a fully underwritten pre-approval process where we complete underwriting, an underwriter reviews the file, approves the income, conditions them, and asks them for whatever else is going to be needed. And then we have a fully underwritten approved loan, except for the title and appraisal. So all you have to do is get a house under contract, order the appraisal. We can close these in like 7 to 9 days, super quickly. And that can help you to compete with cash offers, potentially waive appraisal contingencies in some cases. If they're doing, say they're doing a conventional loan with 20% down or more, sometimes appraisals are even getting waived. So if you have somebody that's actively making offers in the next 60 days, they're willing to provide all their documentation to the lender up front, then we will go to bat and jump on those quickly to help people get approved. So that's all I had for today. Does anybody have any last questions before we finish up? Is there anything in the chat, Paula? Or... No? Okay. All right. Well, thanks for joining us, and we'll see you later. See you next time. All right. Bye, guys.